Hey everyone, it's Mike Valtos from Orderflows.com, and today I'll be talking about using order flow imbalances to determine market turns. And today what I'm going to, make sure I got my screen working here. Today what you're going to learn is I'm going to reveal to you an easy way to understand order flow imbalances that has a potential to change the way you trade the market. Now my goal for you today is to explain what are order flow imbalances and what do they mean, how to use order flow imbalances to see trap traders, how to determine market shifts with order flow imbalances, and I'm going to show you some trading strategies you can implement with order flow imbalances in your existing way of trading. And if you stick around to the end, I have a new little guide called Trading Order Flow Imbalances. I'm going to show you how you can download it at the end of this presentation. Now, what I'm presenting here is what I've developed for myself and built my trading career on. You know, I hope you can find things you can use in your trading and you can adapt and modify for your own trading. Now, I'm not saying you have to follow what I say just because I say it. You have to evaluate everything you come across from me or elsewhere, or from the other speakers today, and decide if it's going to help you in your trading. If not, you reject it. And becoming a successful trader is a journey. It's not something that happens overnight. You have to realize that when you begin trading, you're new to trading, and unfortunately you don't compete against people at the same skill level. Immediately you're thrown into the fire and you're trading against some of the best traders in the world almost immediately. So you're at a disadvantage in that sense. That's why I'm grateful to Investor Inspiration for having these regular trading summits, so you can get up to speed on trading, and you can bend that learning curve and become a better trader sooner rather than later. And when I talk about this is what I've built my trading career on. For those that don't know me, just a brief background about me. I've been trading at the institutional trading level for over 20 years. For 8 years, most recently before I started Order Flows, I was vice president of futures trading at JP Morgan. Prior to that, I was a licensed Eurex trader at Commerce Bank for 3 years. I traded Bunds, Bobbles, Schatz, DAX, Euro stocks. And before that, I was with Cargill for 4 years. And I even was setting up trading desks around the world for Cargill. I set up a desk in Singapore for them to trade futures. And before that, I was with EDF Man for a couple of years. Cargill and EDF Man are two of the biggest and oldest privately held commodity trading firms in the world. And if you're not familiar with them, you should just check them out, because commodities are traded mainly by big privately held commodity trading firms. Cargill has been around since the 1800s, EDF Man since the 1700s. That's how old these companies are, and they really fly under the radar. But again, brief tip. Sometimes people email me, hey, how can I get into the trading industry? Go to a firm like a Cargill or an EDF Man and get a job there. It's a great entry level. It's a great way to get into the commodity trading business, and you could move on from there. And before that, I started on the CME floor. I started with Dean Witter. As a runner. I literally started at the bottom of the industry and worked my way up. And when I saw electronic trading take off in the futures markets, with Globex, Project A from the Board of Trade, and NYMEX Access, I took the opportunity to leave the trading floor and work upstairs on the trading desk, where I was really exposed to all the markets around the world, and literally the futures markets, electronic trading, since almost not the inception, but from a very early stage. And I feel that's given me an insight into the markets that a lot of people just don't have. Now, in 2013, I left JP Morgan to spend more time with my family, and I started to write a book on trading order flow. And again, that was my specialty. That's what I built my trading career around, is order flow. And I was trading for myself. I was using another company's order flow software, but I realized, it was just the basic software. It just gave you a footprint chart. And, with computers, you can have the computer do an analysis for you. So I sat down with the programmer, and, I said, hey, I want the software to help me see price rejection, price support, absorption, and other market nuances. Now, these were nuances and things that I would look for in the order flow myself. But if I could have it programmed into the computer to highlight those areas to me, it would take some of the burden of market analysis off me and could help me look at more markets and look at other things happening in the market. Now this software runs on NT7 and NT8. That's NinjaTrader 7, NinjaTrader 8. There's a Sierra Charts version that I have in partnership with Emoji Trading. And if anyone is on Motive Wave, it's under development right now with Motive Wave. So, there's different avenues you can go as far as software. But again, this is not about me. It's about you. I want to show you how order flow analysis will help you in your trading in the least amount of time possible. Again, when you're beginning trading or you're learning something about trading, you want to get from point A to point B as quickly as possible without getting lost. Sometimes you sit down and you read a book on trading, it starts getting your juices flowing, and then you start going off in a different direction. You want to keep you focused and go in one direction. So let me be clear, you have to make trading decisions. That's what trading is about. It's about making decisions. Order flow is not a red light, green light trading system. It's not, oh, you got a red arrow, you sell, or a green arrow, you buy. But when you understand order flow, you'll understand what's happening in the market, and your trading decisions will become very clear. You can almost anticipate what's going to happen, and you'll have like a trading plan already in your head where you'll see the market develop, and you'll know that, okay, well, if I see this happen, I know I'll want to get long, or if I see this other thing happen, I'll want to get short. Now, before I jump into everything, a brief disclaimer. Again, I go through this disclaimer every presentation, every video I make, even on YouTube. I go through this because I want people to understand there is risk involved in trading. Nothing is risk-free in life or in trading. And this presentation is for educational and informational purposes only. It should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Now, again, the reason I want you to know, the reason why I do that disclaimer is because I want people to know that, trading is work. It takes effort on your part, and again, there is a chance you can lose money. Whether it's trading, whether walking across the street, you get hit by another car. There is risk involved in everything you do in life. Now, over the last 3 years since I started Order Flows, I've worked with a lot of retail traders. When I trade on the institutional side, I didn't really sit down with the other traders and talk about why traders fail because, pretty much everybody I worked around was a successful trader. But then as I left the corporate world and I started working with retail traders, a lot of them were having the same problems. Everyone would say, hey, you know what, I'm losing money, this is what I'm doing, and I would take my notes and I'd try to get to the bottom of what was happening. And I came up with 3 main reasons, over talking to many, many traders. And number one is they don't understand the markets. Again, most traders come into the trading industry on the retail side thinking they could just buy a trading system, off the shelf that's guaranteed, no drawdown and, 50% return on your money per week or something like that. It's just not realistic and it's not going to happen. Number 2 is they take on too much risk. They're highly leveraged, and that's not how you should be trading. And number 3, they spend too much time learning and not enough time doing. They spend all their time in sim and without actually trading in real time with real money. There's a big difference between trading with real money and trading with paper money. In paper money, you don't have the emotions that you go through with real money. And I'm not saying, you got to go take your life savings and put it in an account. No, you can open a small account, trade, a mini contract or even a micro contract that they have out there where, if you suffer losses, it's not going to damage you too much, but it'll get you in that mindset of trading with real money and going through the emotions that, everyone should go through when you're trading with real money. I know a lot of people that have made this jump from sim to real trading and stumbled, and that's because of the emotions that are involved. It's in sim, when you have 3 or 4 losses in a row, you don't think anything of it. But in real life, when you have 3 or 4 losses and it's real money involved, they tend to pause, they tend to hesitate. And you have to get past that if you want to become successful in trading. So again, it's okay to practice in sim, but at some point you should make the jump sooner rather than later. Now, order flow makes it easy for traders to find hidden strengths and weaknesses in the market, and especially in what I'll be talking about today, imbalances in the market. Sometimes they're hidden in the market that you can't see it if you're just looking at a normal bar chart. Order flow makes it easy to determine if highs or lows are going to hold. It helps you see market-generated support and resistance levels, and it helps you determine if price is being rejected. Again, this information is available to all traders. However, if you're just using a normal bar or candlestick chart, you're not going to see that information. But in order flows volume footprint chart, will highlight this information to you. They'll highlight all these things and more to you if you want to see it. And there's no reason why you shouldn't want to see it. So the first thing I want to talk about today is what are order flow imbalances and what do they mean? You know, you have to realize how the markets trade to understand what an imbalance, if there's a market imbalance, right? Markets move from balance to balance. You know, it's going to be one price level to another price level, one value area to another value area. It's going to find balance, it's going to find a new balance, and that area, that movement is where you can make money. Right? You're not going to make money trading in an area that's balanced where everyone's happy to trade. It's that movement from balance to out of balance to the imbalance area to finding your new balance area. So on a basic level, you know, futures markets trade in a two-way auction. There's a bid and there's an offer. Like you see in this example, this is a DOM, a depth of market. Most trading software comes with it for order entry. So you see here, the market is 85.61 bid, offered at 85.61.5. Now there's 95 on the bid, there's 73 on the offer. This is how you compare the bid and the offer. It's 61 you want to buy. If you want to bid, you bid 61.25. If you want to sell, you try and sell 61.5. Now you can buy at the market and pay 61.5, or sell at the market and sell it at 61.25. Now what a lot of people don't understand is there are different types of buyers and different types of sellers, right? Because if we're all just bidding and offering, no trade's going to happen. If everyone in the world wants to buy at 61.25 and everyone wants to sell at 61.5, no one's going to trade, because, you know, there has to be some movement. Someone has to sell it to the bid, or someone has to buy it from the offer. So when you break it down, what you have is four types of traders. You have a passive buyer, is someone who tries to buy on the bid. Passive seller is someone who tries to sell on the offer. Now, when you look at the DOM, it's passive buyers are basically people trying to buy on the bid or below. So you see 61.25, there's 95 buyers. 61 even, there's 77. 60.75, there's 8. These are passive buyers down here. They're waiting for the market to come to them. And sellers, passive sellers, are people that are on the offer or above. So at 61.5, you have 73 contracts, 89 at 61.75, 88 at 62, 9 at 62.25. These are passive sellers, these are passive buyers. Now what you have, and this is where the beauty of order flow comes in, is you have what's called aggressive buyers and aggressive sellers, and order flow allows you to see it. So an aggressive buyer is someone who buys the offer, basically buys at the market. Aggressive sellers sell at the bid, they sell at the market. Remember, for a trade to occur, someone needs to be aggressive, right? If the market's 61.25 bid at 61.5 offer, and an aggressive buyer came in, they would come in and buy at the market at 61.5. That's an aggressive buyer, someone that buys the offer. If an aggressive seller comes in, it's someone that comes in and sells it at the bid at 61.25, you know, at the market. That is an aggressive seller. The passive buyer buys it at 61.25 from the aggressive seller. Someone comes in, hey, I'll sell it to you. Okay, they sold it. They are being the aggressive seller. The person that's bidding at 61.25 is the passive buyer. Now, all this information, again, you know, it's available out there for traders to use. Again, not many people use it. If you know you're familiar with time and sales, all of this trading appears in the time and sales, which is published by the exchange, you know, in a real-time basis. And honestly, if you look at a time and sales stream, it's super fast, and a lot of people can't keep up with it. You know, you're talking about hundreds of trades in a second sometimes. That you know, you'll see a trade, it'll just disappear in a blink of an eye. Now, an order flows traders footprint chart will take that information and put it into an easy to read and analyze format. So each bar is going to show you the volume traded on the bid and the volume traded on the offer. If it's on the left-hand side, it's the volume traded on the bid. If it's on the right-hand side, it's the volume traded on the offer. And what this is going to allow is going to show you times where you have buying imbalances or selling imbalances. And it's going to be highlighted in the bar with blue for buying imbalance or a red number for a selling imbalance. Again, you're comparing the market bid against the offer. So if, for example, you have a selling imbalance here, 1976, it's a red number, versus the offer at 179. So you had 179 lots of aggressively bought versus 1976 aggressively sold. So this is a ratio of more than 4 to 1, 400%, which indicates a selling imbalance. Now you can adjust the ratios. Now the market standard tends to be 400%. You could use any number you want. You know, 400% is a good starting point for many people. I use it. I also use 1000% to refine some certain markets. And now here you have a buying imbalance, 8 against 4277. Obviously that's well over 400%. This is a buying imbalance. 8 lots traded on the bid, 4277 traded on the offer when the market was bid offered here. And over time, when you start stringing the bars together, whether you're using a minute-based chart or a range-based chart, it'll become market will reveal itself to you, so you can make better trading information. So you can see areas where prices being rejected, or prices being supported. You can see areas where traders are being aggressive, either on the way up or on the way down, and many other things. And on a normal bar chart, candlestick chart, you're not going to see that information. You're just going to see where the market opened and it closed, basically. And it's going to be colorful, and you'll think that that's great, but you're really leaving out a lot of information. Now, just really briefly, it's a little fill you in on order flow. There's 3 basic things you need to focus on with order flow, building blocks, so to call them. Point of control, delta, and imbalance. Today I'll be talking about imbalance. Point of control is the point in the bar with the most volume, and it'll be highlighted with a rectangle around it. Now, I like to put it gray in there because I'm a visual person. The mind can process visual things a lot faster than it can numbers, and I just like to see where it is. And again, it's the point in the bar with the most volume, and that's very important information. I've done many videos and webinars on it. You go to YouTube and subscribe to my channel, you can watch those videos. And it's very revealing onto direction of the market. Delta is the difference between the net difference between aggressive buyers and sellers in the bar. And it generally runs along the bottom of the chart. You can see down here, delta. You can see if it's if it's a green number, it means positive delta. So you had net aggressive buyers in this bar versus the next bar, you had a delta of -6. You had net aggressive sellers of 6 more aggressive sellers than aggressive buyers, and so on. So you see different numbers, -43, 226. And again, delta is also very revealing. It's a great tool that not many traders use in their trading. So again, these are the 3 building blocks of order flow that you need to understand, and will really help you in your trading, put you head and shoulders above many other traders out there that are just looking at price-based charts. Point of control is the price level in the bar with the most volume. Delta is the net aggressive buyers or sellers in a bar. And imbalance, which I'll be talking about today, is when there are more aggressive buyers than aggressive sellers, or more aggressive sellers than aggressive buyers in the two-way auction by at least 4 to 1. And again, buying imbalances in the volume footprint chart will be blue color. Selling imbalances will be red numbers inside the bar chart, inside the bar. And again, you can adjust the colors. You could just, you could adjust, however you like. Blue makes it easy because, when you think of blue on a chart, you think of a market going up. When you see red, you think of a market going down. So blue for buy, red for selling imbalances. Now, second thing I'll talk about today is, how to use order flow imbalances to see trap traders. Now, trap traders is a term that gets thrown around a lot by people, and honestly, traders are never really trapped. You can always get out for the most part of a position, unless you're in a commodity that has daily price limits and the market may go lock a limit and you can't get out. But generally, for the most part, you always have a chance to get out. It's just at how bad a price you want to get out. It's not like you're going to have 5,000, 10,000 traders stuck in a position. No, it's going to be a handful of traders that are long and wrong, as I like to call it, or short in the hole. Now, when I created the Orderflows Trader software, I wanted software to show me areas where traders are long and wrong or short in the hole, because these are great short-term opportunities to fade those stuck traders. And imbalances help show me those areas. Right, and again, that's the beauty of order flows, is it helps you see when people are potentially trapped in the market, or long and wrong or short in the hole. Now, being long and wrong occurs when traders get in late to a rally and buy the high, and then the market immediately sells off. We've all been in there. I'll admit it. I used to be a breakout trader, and sometimes we make a new high. I think I get in. We're making new highs. We're going higher. I buy. What happens? The market makes a new high by 1 or 2 ticks from where I bought it. Then immediately turns and sells off. I'm long and wrong, right? And I got to get out. Being short in the hole occurs, it's the opposite of long and wrong. Being short in the hole is when you get short at the end of a sell-off, basically, and the market turns and starts to rally. The market breaks out, it's selling off, especially when the market's selling off. Sometimes you get really excited, like, oh my gosh, I don't want to miss this move, fear of missing out, FOMO, for you Bitcoin guys, and you get in. And unfortunately, the time you get in is too late, and the market hits its bottom shortly after you get off, or get into your position, or just after, and then the market starts to rally. We've all experienced that. At least I admit it. And I know a lot of people experience that. But those are two terms. Keep in mind: being short in the hole and being long and wrong. Now, the Orderflows Trader software will highlight these areas on the chart. For a buy, there'll be a green arrow underneath the bar. For a sell, there'll be a red arrow above the bar. But again, don't take those as red light, green light signals. Take things in context of the market. You got to understand what's happening. Now, again, it's not rocket science, but there is some science to it, right? If the market is breaking out of recent highs and you see, a signal indicating trap traders, analyze it. Take 2 seconds to look at it and say, okay, yeah, I know what's happening here. Traders aggressively bought this high here, right? We're making this new high, right? If you look left, you can see we just took out the recent high from, a couple hours ago. And you got aggressive buyers coming in here with the buying imbalances. And then what happens? The market turns around and starts selling off. And then, boom, the next bar is lower, lower, lower. These traders bought expecting a breakout, but they're wrong. They're long and wrong, right? Now, again, if you're thinking, well, trap traders, some people have you believe that, oh my gosh, as soon as they buy it, they got to start getting out. But, you're only talking, look at these volumes here, 85, 79, 13, 152, 60. Even here, if you add in 400 and 100, yeah, you're talking about 750. But there's plenty of volume, and these bars are trading 2,700, 2,000, 2,600. So it's not like they're trapped that they're going to get out $1 lower. They just got to get out at. They got to determine at what price do they want to get out at. Now here's another example. These guys are trying to trade a breakout. Right, you can see the pounding down into these lows, selling imbalance into the lows, selling imbalance, selling imbalance, selling imbalance. Finally, it kicks in with the green arrow. These traders are trying to get it low, but what's happening? They're running into a big bid there. Someone is absorbing all their selling. And what happens when those sellers run out of bullets? Well, there's no more selling pressure in the market. The market's going to just gradually tick up. You can see here, once these sellers are done, it's just sort of hanging around here, and then boom. Market jumps from 41 up to 43 in one bar, like that. Because why? Because the sellers are done. They got no more inventory to sell. They sold all their supply. Okay, so there's no more pressure on the market, no more downward pressure. So are these guys going to cover? I mean, who knows? I mean, you don't know what that selling is. Or it could be against a cash position. Oh, this is 5 in the morning. It could be against a hedging position in Europe or something. This is the S&Ps. You don't know. You don't care. All you know is reading what's happening in the order flow. Someone is absorbing all that selling in here, and finally the selling pressure is over. They absorbed the buyers, passive buyers absorbed all the aggressive sellers, and what happens? Selling is gone. The market just naturally moves higher. That's an easy one. Okay, here's a new one. This is Euro currency. This was like yesterday, I think. We just shot up very quick. Boom, you see a lot of buying imbalances on the way up. All these blue numbers in the bars. Then boom, we hit this bar right up here. Forex guys will say, well, it's a pin bar, Pinocchio bar or whatever, or evening star. You got to get short. Well, that's great, but if you can add order flow into it and help refine it, because I've seen a lot of bars like this where it's like this, and then the market comes down and then shoots right back up. That's the thing with candlestick guys. It's when they work great, they all sit there and toot their horn, but when they don't work, they don't say anything about it. But you can see it here, right? These guys, everyone's getting euphoric. Everyone's piling into the market, being aggressive, buying it. And then, the last people come to the party, hey, let's get this party started. But then they realize, oh gosh, I bought, and we're not going higher, because you need follow-up buying for the market to go higher. If there's no more follow-up buying, the market's not going to go higher. And again, once that buying dries up, what's going to happen? Market's going to sell off, right? Because there's no more buyers in there to support that market. So that's how I view trap traders: long and wrong and short in the hole. Now, the third thing I'll talk about is determining market shifts with order flow imbalances, supply and demand. Now, markets rally when demand exceeds supply. Markets sell off when supply exceeds demand. More economics 101. If you've ever cracked open an economics book in college, you'll understand that. When markets are in balance, supply equals demand, right? People are happy to trade at a price of equilibrium, a price that everyone is happy with. And this is the law of supply and demand. And remember that. It's called the law of supply and demand. It's not the theory of supply and demand. You know, it's not talking ancient aliens came down here and said this is how it's going to be. No, this is how it works in not only in trading in the markets, but in real life. You know, whether you're buying a house or buying a car, buying groceries, you know, it's supply and demand. Now, how can imbalances help you determining shifts in supply and demand? Well, when you have, you know, there's something in order flow imbalances called stacked imbalances. And what it is when you have 3 or more imbalances in the same direction, basically stacked on top of each other, one on top of the other on top of the other, that's a stacked imbalance. Now there's something else which my software highlights. If you don't have my software, you just have to focus on your chart to look at it more and see it is an imbalance cluster or a multiple imbalance, which is basically 3 or more imbalances in the same direction in the bar. Instead of being stacked one on top of each other, you know, they may be 2 and then just a normal level with normal order flow and then another imbalance, or, you know, they could be spread out a little bit more. It varies. And you'll see, right? I'm talking about shifts in supply and demand. Markets move lower when supply is in control of the market. And once a supply-driven market goes down. Then you hit the low area. Now again, you know, anytime you hit a low area coming down to a bottom, you should be asking yourself, well, what's going to happen? Are we going to keep going lower? Or are we going to turn around and go higher? And, you know, markets don't just drop down immediately, then immediately turn up. Sometimes, you know, they go sideways. And it's oftentimes in that sideways action, you can see things. And you'll notice here, right, the market is going down. A lot of selling imbalances, aggressive sellers in control. And then you get this bar down here. You got the stacked buying imbalance. It's also an imbalance cluster because it's 3 or more. In this case, they happen to be stacked on each other. And okay, you know, maybe you're not convinced yet, and you know the market does poke down, make a new low, but then watch as it starts coming back up. You see imbalance on the bar on the low, the next bar, a couple of imbalances, and then another bar later, 2 bars later, you got another multiple imbalance, a stacked imbalance this time. And what do you think is going to happen? Do you think the market has got a better chance to rally or a better chance to sell off? You know, at this point, I see much more. The market is much more slanted towards buying imbalances. So I know aggressive buyers have come in at this low area and said, hey, you know, this is a great buying opportunity. And they start piling in and are being aggressive, right? You don't have the aggressive sellers anymore. You have the aggressive buyers. And what happens is a continuation. You notice over the next few minutes, we rally from 2,700 all the way up to 2,705. You know, this was the sign down in here when you came into this low. Ask yourself, what's happening in the market? What can I do to profit from this? You know, is this market going to keep going lower, or is it potentially going to change and go back up? Again, it's not about trying to pick a high or a low. It's let the market reveal itself to you so you can take a trade and profit from it. Now, here's another example. This is crude oil, right? We're rallying up. Okay, in this case, you don't have a lot of buying imbalances on the way up, but then you hit a swing high up here, and it just starts going sideways. But then what happens? You have a selling imbalance cluster here. You got 1, 2, 3 imbalances in here. Okay. Again, maybe you're not convinced. And again, I'm not going to get into analyzing the delta, but the delta is very revealing, as well as the point of controls. But again, you should watch some of my other videos to learn more about that. Or, you know, because again, you can see how this market is starting to fall over. It was demand driven on the way up, sort of hits an equilibrium area where people are happy to transact at a price that they consider fair for now. And then, you know what, sellers start to come in. You start seeing selling imbalances. And then, boom, you know, say you're not convinced here. Here, again, you get another selling imbalance cluster, and then the market sells off. You know, this is the market revealing itself to you, telling you, hey, you know what, aggressive sellers are showing up in the market. Again, another crude oil chart. This is yesterday or the day before, I think. Again, we're rallying up. Imbalance cluster, buying imbalance cluster, buying imbalance cluster. You got a stacked imbalance, right? Then the market turns, sells off. Selling imbalance cluster, selling imbalance cluster. Hits this swing low, buying imbalance cluster, and makes its way back up. Now, there's a few things I want to talk about here. One, yes, you have a buying imbalance cluster up here and a stacked buying imbalance. You say, well, it didn't work out, it failed. Okay, again, analyze the market. You know, again, you got to think, right? Don't be a chimpanzee, you know, just taking orders. You know, as a trader, you got to constantly be making decisions. Now, what would you rather be taking? Aggressive buying up here or down here? You know, the market moved basically from 61.80, this is 61.80 down here at the bottom. This buying imbalance clusters here is trading around 61.95. Or do you want to be buying it up here at 62.25, you know, 30 cents higher? Of course, you want to, it's better to take the signals at a lower price area. yeah, the market can keep going higher, but again, you got to be understanding what's happening in the market rather than just taking these things blindly. Another sign that this one failed is obviously the next bar came in and it just sold off right into that imbalance and got on the other side. That's also a negative sign. And then of course you hit your swing high. You had some selling imbalances coming in here, selling imbalance cluster, another selling imbalance cluster with stacked imbalance in here, and the market sells off. Then you hit down to this area. Now notice this buying imbalance. This is a stacked buying imbalance also in cluster, but notice it's around that same area where we had the aggressive buying earlier. So market shot up, sold off to an area where you had the aggressive buying earlier, right? It's not like the markets just anyhow rotate up, down. They come back to areas often where earlier you had signs of aggressive buying, right? Market was here, aggressive buyers came in, thought, hey, this is a great area to be buying it. Market rallied, sold off. They were still interested down here. They're still interested to buy. And the market continued on its way back up. So the fourth thing I'll cover today really quick is I'll give you a couple strategies you can implement with order flow imbalances. Again, if you use my software, it's very easy, but again, if you're using another company's software, you can still use it. You just got to know what to look for, and I'll try to explain it a little bit to you here so that you can understand it. So the first one is imbalance on the extreme. Now this one is coded into the Orderflows Trader software, and what it is it occurs when there's a buying imbalance at the top of a down bar, a red candle, or selling imbalance at the bottom of an up bar, a green candle. Okay. Now the Orderflows Trader software highlights these areas on a chart with a green arrow for a buy and a red arrow for a sell. And I circled it here so you can see. So the market is selling off. Boom, 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 making new lows, making new lows. People are coming in, hey, let's sell this market. Okay. They get aggressive, they sell it. Boom, what happens? It doesn't go lower, right? It snaps back, starts trading higher. And in the next bar, this is a 1-minute NASDAQ chart. And you can see the market makes a nice move up over the next several bars. Again, order flow imbalance on the extreme is not something that's you're gonna hold for hours. It's something that it's more of a short-term thing. You're trying to trade the swings, the moves, and again, look for them at the ends of swings as opposed to sort of in the middle of moves. I find it more effective, even though I'll highlight it because I still want to see it if it occurs. I still want to see these things, these potential trap traders, but I love them, when they occur at swing highs or swing lows, especially after you just take out a high or a low or a recent high or a low. For example, here's a swing low. We just took out these previous lows here. Again, the aggressive sellers, market's inching down. You're thinking, breakout traders, hey, this is it. We're going to trigger some stops and go lower. What happens? They come in, they're aggressive, but they're wrong, right? They get in too late. They're sort of probing for the market, trying to move it lower. It didn't work. They cover back. Sure as heck, what happens? Boom, the market rallies. And this is a great move. You're talking 68.40 up to 68.50 in 3 minutes. Those are the moves as a trader you love to get. Now here's one, right? We just took out a swing high here, right? If you look over, you sort of poke higher, okay. Then boom, you got 113.76. It's indicating there's trap traders up here. And again, what's going to happen? Is the market going to go higher? As Hillary Clinton would say, why aren't I 50 points ahead? You got all this aggressive buying coming in, 113 lots. Someone just swept up the market and just bought everything, hoovered it up. But where's the follow-up buying? You need the follow-up buying, and it's just not there. So there's no more buying interest at that area. And what happens? Boom, market sells off. Next bar down, next bar kind of sideways. Then boom, the bottom just falls out, from 68.52 down to 68.42. This is a 1-minute chart again. Nice moves. Where do you place your stop? You place your stop just above that high, so you know where you're going to be placing your stop. Imagine you're getting short here, 68.54, stop at 58. That's 4 points. You're short at 54. It trades down to 42. It's 12 points. You're risking 4 to get 12. Another great example. Took out this recent high here, right? Buying imbalance is all on the way up. Where's the follow-up buying? It's not appearing there. These guys are long and wrong. Then the next bar, these are the bars you love to get when you're trading, is the 10-point moves in the NASDAQ in one bar. These are the ones, granted the volatility is off the chart, when I say off the charts, but volatilities, NASDAQ is pretty high nowadays, that you get these nice charts, these nice bars. But again, you know where you're going to place your stop is right above, somewhere up there. You shouldn't be retesting that area. If you retest that area, it's most likely going to fail. And boom, it's a nice sell-off, right? Those are the trades that you like to get as a trader. Now, the next strategy is the imbalance clusters. Okay, now earlier I talked about stacked imbalances and imbalance clusters. I treat them the same. However, imbalance clusters are multiple imbalances in a bar that are not stacked. And this is not on the NT7 version, it's on the NT8 version only at the moment. And it highlights the areas on the chart where you have a bar with multiple imbalances that are not stacked, and it'll put a box around it. And this is how it looks, right? You'll see here where the arrow is, you have this fuchsia box around it indicating you have stacked multiple imbalances that are not necessarily stacked on each other. Unfortunately, it will also show a stacked imbalance. It'll put a box around it, but that's because it's 3 or more imbalances in the same direction in the bar. But again, it's hidden, right? And the reason I love this more than stacked imbalances actually, because it's not something that a lot of people are trained to look for. Where our eyes are trained to look for stacked imbalances. They're not trained to look for multiple imbalances in the same direction in a bar. People are just not trained to look for that. But when you can see it, when you realize the importance of it, it's telling you they have aggressive buyers in this area. And again, you're sort of working your way down. You make this swing low here, okay? And then you start sort of rotating back up to this area where you're going sideways. Then what do you see? You see aggressive buying coming in here. Okay, maybe you're not convinced yet. Next bar comes back down. Whew, good thing I didn't take it. Well, look at this next bar. What do you got? You've got more aggressive buying coming in here. We've got 1, 2. It's not multiple. It's not more than 3. But again, it's coming down to an area where you just had aggressive buying. So these aggressive buyers are still active here. They still want to buy more. And what happens? Well, the market moves up from 62, 75 all the way up above 63 bucks. Now here's a nice one. The NASDAQ again. Market's selling off, selling imbalances all the way down. Imbalance cluster on the low, selling imbalances. But then what happens? Almost mirror image in the opposite direction. Buying imbalances coming in. You have multiple imbalances. Next bar is up, right? Next bar, you got a couple imbalances. Then this next big bar up here, you've got several stacked imbalances. You have 2 stacked imbalances. You got a bunch of imbalances in the bar. It's multiple imbalances, imbalance cluster. Now let me ask you, where would you rather be buying? In this bar before you got the big bar up, or after you see these stacked imbalances that you get in way up here? This is the bar you want to catch. I mean, it's nice that it continued up, but if you could catch this bar, before it happens, that's great. Yes, these stacked imbalances are nice to get, but where would you rather be getting long? 68.90? We're down here at 68.80, 68.82. You just caught a bar with 10 points basically. That's what you want. Again, it's hidden, right? If your eyes are only trained to look at stacked imbalances, you're going to miss the multiple imbalances in the bar. Okay, here's another nice one. Okay, again, market's shifting. Think of it as moving from from demand to supply. So you're moving up, stacked imbalance in here, multiple imbalances, buying imbalances on the way up. You hit the high. Okay, what's going to happen? Are we going to go up, keep going up, or are we going to turn around and start selling off? Well, you got this bar here. It's a big red candle. You got a selling imbalance in there. And in this one, the delta is very revealing, as well as the point of controls. However, I just want to keep this on imbalances. But watch what happens, right? Next bar, a couple imbalances, then boom. The next bar, third bar, you got the multiple imbalances. So if you're not convinced on the high, okay, maybe honestly, I probably wouldn't, but I'd be alert. My spider senses would be tingling. The next bar as well. You see higher delta in the sense of negative delta increasing. Point of controls are lower. That's also a nice sign. We pull back up to that point of control. Then this next bar, multiple imbalances. To me, that's a sign. It's go time. Let's do it. And what happens? We sell off from 63.75 down to 63.30 basically over the next 15 minutes. The signs were there. The signals were there to to get short. Okay, another one. As again, aggressive buying on the way up. You see buying imbalances all in these bars. You got multiple imbalances on the way up, You hit the high. Okay, well, what's going to happen? Well, let the market tell you what's going to happen. Again, don't try to pick the high. Don't say, well, we hit this high, I got to sell here. Because if you sold off this high, you would have lost. You sold off this high, you would have taken a loss. But it gets really clear in here. You got to stack selling imbalance. You have some more imbalances in the bar. So it's a lower risk trade, rather than just selling because you made it high. Let the market reveal itself. So if you're getting short here, 69.09, where's your stop? Your stop is up here, 69.12. Call it 69.13 above here even. So you're short at 9 with a stop at 13. That's 4 ticks. And it trades down to what? Below 6,900. So you're talking, you're risking 4 to get back at least 8, 9, 10 points rather. So you're risking 4 points to get back 9, 10. Those are the type of trades that you like to get. I mean, of course, you'd love to get the ones that 25 to 1, but let's be realistic. When you're trading intraday, you often don't get those types of things. So hopefully by now you can see how powerful order flow analysis is. If you think it's difficult or easy, I like to think it's easy. I like to keep things simple, right? And order flow is about as simple as it gets. So if you found this helpful, I've got a package put together for people to get their knowledge up to speed as fast as possible. It's my Orderflows Trader software package. I call it the all-in package, and it's the easiest and fastest way to trade with order flow. You choose consistency in your trading and have control over your trading, so you know why you're taking trades, as opposed to just, oh, I should buy here because it says the bar is turned green or the bar is turned red, so I should sell. No, that's not trading. That's trade following. You're not making decisions based on your own analysis. You're making it based on some black box that you don't understand. Again, it's not based on luck or being special. There are trading savants out there, I'm sure. We had a guy at JP Morgan, he was blind. The thing was, well, he's a better trader because he's blind because it made his other senses better. Okay, fair enough. I could buy it. The guy made money. But again, those situations are very rare. And once you understand what's happening in the market, you'll find the market just makes sense. You can almost anticipate what's going to happen in the market. So again, stop flushing your money down the toilet, chasing some holy grail that just doesn't exist. Remember, 90% of the traders out there lose their old trading account in the first year. Why is that? Because they don't know how to trade. It's basic, right? You're not going to become a doctor just by, oh, I'm going to wake up, I'm going to become a doctor. No, you got to train. You got to learn. You got to work with someone that's already experienced doctor, and learn how to cut people open and perform operations. And trading is the same way. You got to learn from someone that's traded professionally, knows what they're talking about, not just someone that took a course and all of a sudden, hey, I'm a trader. No, it doesn't work that way. Trading is what I did. It's why I paid my bills for over 20 years. Paid for my house, paid for my car, paid for everything in my life. That's what I did for a living. And don't do what people are doing that keep losing their money in the markets. You got to learn how to trade. And the Orderflows Trader software package, it runs on NinjaTrader 7 or 8, and includes the volume footprint chart with 4 pre-programmed indicators. I talked about one of them today, and actually the other one is available for NT8, so that's actually 5. I'll also give you my chart template so your charts can look just like mine. No sense, don't spend a lot of time wasting trying to get your charts set up. It's something that you can get going right away. But again, having order flow software is one thing. The next thing you got to do is know how to use it. And I don't just give you the software, send you on your way. I provide a lot of extra education on how to trade with order flow. And today I want to give you access to the Orderflows trading course. Normally I sell it for $297. It's 15 hours, 20 lessons on order flow analysis. You can download the videos to your tablet or smartphone and watch them and listen to them in your car or wherever on the train. And as a special bonus, I'm going to give you access to my inner circle. Right? It's over 56 videos on order flow analysis, advanced information you're not going to find anywhere. This is information that I've recorded because I want something to have, for my kids if they eventually want to trade, something they can refer to. It's got all my additional indicators. You get those for free. This is my proprietary knowledge and tools. And normally I don't offer this out to people. Maybe once or twice a year I have an intake, and I sell it for $1,000, $997 actually. So when you start adding this stuff up, the software by itself is normally $900, $899. The Orderflows trading course $297. The advanced training is $997. That's over $2,193. But today you get it for a one-time payment of $1,250. Just go to orderflows.com/all-in, and it'll take you there. No monthly payments, nothing else to worry about. It'll take you to this page. Type in all in, takes you to this page. You just scroll down, get to the bottom, type, click the button, I'm all in, takes you to PayPal, simple. Process through PayPal. I don't get your information. I don't want your information. It's a third party. Everyone's familiar with PayPal if you ever bought anything online. And it's really simple. But again, what other people are saying, this is from Facebook, I think it was, Mike, your order flows trader software is remarkably helpful. I can clearly see now what's really happening in the market, like for example, who's in control of the market on a very specific time and who's getting weaker as well. So go to orderflows.com/all-in. And if you stuck around, you want a copy of my guide, go trading order flow imbalances, go to orderflows.com/imbalances.html, and you have to enter your email, you get on a list, and it'll take you to the download link right after you enter that information. So, without further ado, I'll just wrap it up here for everyone. Go to orderflows.com/all-in.html, and I hope to see you guys on the inside.